He was still at work during the day, but at night he received a message that he had been laid off. GAC Toyota, a Fortune 500 company, announced layoffs. It was supposed to be a pillar industry in Guangzhou, but in an instant, 1,000 to 2,000 employees were out of work. My classmate said the layoffs came too suddenly. There was no preparation at all.
Once, the Chinese auto market attracted auto manufacturers from all over the world. However, sales in the Chinese auto market are gradually decreasing, and the inventory warning index is constantly rising. Those once thriving car factories have started to close down, yet the inventory of cars are still piled up. For these foreign auto companies, this is not the market they want. Therefore, foreign car companies with rich practical experience are making global strategic adjustments. Many foreign car companies have withdrawn or are withdrawing from the Chinese market, seeking markets with better prospects. Companies that withdrew from the Chinese market and focused on other markets before the pandemic, such as Suzuki, have performed surprisingly well, with global sales surpassing many Chinese auto brands. This result has made many foreign car companies flee in panic. In May of this year, Chang'an Ford reduced its production capacity from 1.6 million units to 670,000. GAC Group's GAC Mitsubishi, after 11 years in the Chinese market, declared an end on July 13. It sees clearly the situation of the Chinese market: weak demand, fierce competition, and continuous losses that would only consume its vitality. Withdrawing from such a market can more effectively protect the group, which is undoubtedly a wise choice. Suzuki fled even earlier, withdrawing from the Chinese market in 2018, avoiding the losses caused by China's zero-COVID policy. They turned their attention to India. Now, Suzuki's sales in the Indian market rank first. The company's actions seem to tell other car giants that the Chinese market is not the only choice. The world is vast. Where isn't a hunting ground? With so many options, Toyota was awakened by Suzuki's move, seeing that the real blue ocean is not in China but elsewhere. So Toyota also began layoffs, shaking hands and saying goodbye to nearly 2,000 employees in the glow of the setting sun, preparing to meet new challenges. The investment returns of GAC Toyota and GAC Honda are important components of GAC Group's economic strength. In 2022, these two subsidiaries brought a total of 14.3 billion yuan in investment income to the GAC Group, an increase of 21.2% year-on-year. But GAC Group's own brand lost 6 billion yuan last year, shrinking the group's total annual profit to 8 billion yuan. If Toyota and Honda both choose to leave the Chinese market, GAC Group may fall into a more severe economic crisis. So, do Japanese companies have the momentum to withdraw from the Chinese market? In 2020, the policy of former Japanese Prime Minister Shinzo Abe successfully drove Japanese companies out of China. Abe's policy provided generous relocation subsidies. Factories that moved to Vietnam could receive half the subsidies, and those that moved back to Japan could receive all the subsidies. This policy had a remarkable effect and triggered a large number of Japanese companies to withdraw. The withdrawn Japanese companies did not suffer negative impacts. On the contrary, they created historical highs globally. This not only made the Japanese stock market soar, but the housing index also showed an upward trend. This eliminated the notion that one cannot survive without China, and more companies began to seek global development strategies, expanding their business to the United States and other emerging markets, looking for new opportunities. On June 1 this year, Toyota announced that its electrical vehicle factory in Kentucky, USA, would officially start production in 2025 and will increase its investment by $2.1 billion to expand its battery factory base in the United States. Toyota's optimism about the US market, as well as its large investments in the US, undoubtedly highlight the status of the United States as a stable and safe investment destination. With its powerful military, outstanding scientific research capabilities, and the world's strongest economy, the United States has become the first choice for many companies seeking new opportunities. Toyota has now reduced its connections with the Chinese market down to between 1/3 and a half, significantly reducing its dependence on the Chinese market and thus minimizing risk. Toyota's attitude is clear. It will make money in the Chinese market if it can, and it can leave at any time if it can't. Of course, most car companies are still fighting in this arena, but the situation on this battlefield is not very good. In June, the warning index for auto dealers' inventory in China reached 54%, a year-on-year increase of 4.5 percentage points, indicating serious inventory pressure. This means that consumers' demand for cars cannot keep up with the market supply, and the ability of the private sector to take on new cars is extremely limited. Worse still, this year only 20% of dealers have met the inventory targets assigned by car manufacturers. In the past, for every new energy vehicle sold, the manufacturer would give a rebate to the dealer. However, now, due to financial pressure, manufacturers find various excuses to find them. For example, if a 4S shop dealership gives customers extra discounts, the manufacturer will find them, making it increasingly difficult for dealers to survive. Data from the China Automobile Dealers Association further confirms this. From the start of the pandemic in 2020 to 2022, 5,519 4S stores have closed in China. If the additional 2,000 stores that closed this year are added, 25% of the total number of 4S stores in China have closed. Therefore, the outlook of the second half of the year is not optimistic for the Chinese auto industry, especially for new energy vehicles. Chinese car companies often use patriotic sentiments to promote their products, but the quality of their products is often disappointing.
The BYD Song Champion Edition, an all-electric vehicle that just hit the market in June, had a serious issue veering to the right the very day it was picked up. The salesperson assured me it was a brand new car, not a showroom model or leftover stock. But I found a small toy inside and the car started pulling to the right as soon as I drove off.
High-tech self-destructing battery rejected by all major insurance companies, we buyers are regretting bitterly.
The BYD Han, it just dies without even an accident. The probability that power has run out is very small. It must be malfunctioning. He said he was going to buy a BYD and he did. Now typing insurance won't cover the two BYD models this year. Only the Qian and Yuan are insurable. Even Ping and Insurance, which is more lenient towards electric cars, won't insure many BYD models.
When cars have issues like spontaneous combustion, they won't tolerate any criticism or questioning, or else you'll be labeled as unpatriotic.
BYD electric cars are nothing but industrial trash. The batteries are all bloated. They can only be sold as scrap. Let's not buy cars with this kind of battery. Earning money is so hard these days. If the battery pack in an electric car is gone, the car is pretty much useless.
BYD has been releasing pollutants in many places, subjecting residents around Changsha to a stinging odor that affects health. Yet, because BYD is considered to represent the country, represent patriotism, these issues go unquestioned. Such behavior will only lead Chinese car makers into self-isolation, and the decline in product quality is not surprising. For example, Huawei has now become a marginalized brand, a well-known fact. In stark contrast, Guangzhou Toyota performed impressively in its 2022 production figures, with a production of 1.09 million units and cumulative sales of 1.05 million units, up 21.4% year-on-year. In the field of new energy vehicles, the sales of Guangzhou Toyota's electric cars reached 300,000 units in 2022, up 55.8% year-on-year. Hybrid models are well received by consumers, such as the Corolla, which is widely acclaimed for its solid quality, with sales increasing nearly 90% nationwide. After achieving good sales performance in hybrid vehicles, Toyota also thinks it should enter the pure electric vehicle market. Recently, the company changed its leadership team, focusing on electric vehicles. If traditional car makers like Toyota and Honda all switch to electric vehicles, the competition in China's new energy vehicle market will be even more fierce. In desperation, the Chinese government has shown a special concern for the development of the new energy automobile industry. After an exchange with Tesla CEO Elon Musk, Li Qiang proposed high-quality development of the new energy automobile industry at the State Council Executive Meeting on June 2nd. It seems that Li Qiang initially hoped that Tesla would increase its investment in China, but Musk's response was cautious, saying he would study the issue in depth at the shareholders' meeting. Therefore, the Chinese government's public relations work did not seem to achieve the expected results, and Li Qiang proposed high-quality development. However, it should be understood that the term high-quality development is often a subtle hint in China's political context as a sign of economic difficulties, and it may also imply that the road to development of China's electric vehicle industry will become increasingly difficult. The recent fluctuations in the industry stock market could be compared to an automotive version of Game of Thrones, a fierce struggle for power. Volkswagen surprisingly poured a generous $700 million into backing XPeng Motors. As expected, XPeng's share price immediately soared by 40%, with the entire new energy vehicle industry stock following suit. Amidst the joy and excitement of this event, Evergrande Auto surprisingly announced that it was resuming trading on the Hong Kong Stock Exchange. Quite frankly, Evergrande was trying to ride this wave, selling a portion of its own shares to raise funds while also making a strategic exit. Meanwhile, we noticed that BYD shares did not bask in this wave of excitement, as there was no significant increase in its stock price. This could be due to the fact that the majority of BYD's funding comes from large institutional investors, including the likes of US magnate and investor Warren Buffett. These institutional investors tend to hold on to their shares even during a bearish market, preventing an excessive sell-off that could cause the stock price to plummet. However, when the market situation improved, a time typically perfect for a price increase, BYD's stock price didn't respond accordingly, suggesting that these institutional investors may have gradually reduced their holdings in BYD stock during the market rebound. What is noteworthy is that BYD recently demanded $500,000 in damages from automotive blogger Dragon Pick Car Collection, accusing it of publishing a large amount of false information, causing severe damage to BYD's reputation. Although this event demonstrates BYD's determination to protect its interests, it may also imply that BYD is trying to cover up certain potential issues. Historically, when a company begins to strongly resist negative news and even initiates lawsuits, it's usually a sign of internal issues. From an investment perspective, BYD's recent stock market performance and public moves are raising market concerns about its future. Consumer feedback on BYD cars has been poor, and the company's public image is on a downslide. Considering all these factors, the problems faced by BYD may be more serious than what the public sees. Likewise, Volkswagen's $700 million investment may have already been compensated for by the recent 40% rise in XPeng's stock price. Therefore, Volkswagen's investment appears to have essentially recovered its costs, and whether the new models to be launched in 2026 can be successfully listed may not be the main issue. Thus, we shouldn't overly focus on the collaboration between Volkswagen and XPeng. Of course, Volkswagen faces its own challenges. In the Southeast Asian market, Volkswagen's expansion plan has not been fully deployed, so it is still hoping to return to the Chinese market. Through cooperation with local brands, Volkswagen is trying to consolidate its position in the Chinese market. This is a common strategy for foreign auto brands in China, and this cooperation also reflects the importance of the Chinese market to Volkswagen. And finally, we arrive at the thunderous tale of the automobile industry in the stock market, an engrossing drama orchestrated by the puppeteers of capital. Volkswagen, with their shrewd investment of $700 million in XPeng Motors, set off a simultaneous rally among XPeng and other electric vehicle stocks. Not too long after, Evergrande Auto announced the resumption of trading with plans to raise $500 million. The invisible strings being pulled from behind the scenes suggest possible manipulation. After all, the funds of many investment banks and investors are heavily entangled in the stock market with no quick exit in sight, especially in Hong Kong, an international financial hub where numerous capitals are deeply committed to the market. The prospect of swift departure is but a mirage. As a result, recurring market trends are manipulated to entice the unwitting into taking the fall. The market rally ignited by XPeng Motors could simply be their strategic exit plan to cut loose and leave the ordinary investors to pick up the pieces. In the current landscape of the new energy vehicle industry, reminiscent of the earlier rush for fiscal subsidies, the companies are likely scheming for a quick escape amidst the booming market trends. This scenario foreshadows potential perils in the future of the new energy vehicle industry, with the looming spectre of bankruptcy. When the affluent stockholders start dumping their shares, it's often the ordinary investors who become the unsuspecting bag holders. Consequently, the reins of control over these companies may shift to the hands of the public, and whether the companies thrive or falter becomes an inconsequential concern for these influential tycoons. In fact, this shift could diminish the company's drive to succeed. After all, if these corporations morph into public entities, their operational success or failure seems to hold no significant weight. If mismanaged, bankruptcy might follow all too easily. Then the haunting question surfaces: what becomes of China's new energy sector should these companies go bankrupt?